Most people look at the stock market and see a stressful casino. It's a blur of flickering red and green numbers, where the game appears to be guessing which ones will jump up by next Tuesday. When Warren Buffett bought his very first shares of stock, 3 shares of City Service Preferred in 1942, he was only 11 years old. He fell into that exact same trap. This chart shows the kind of technical analysis young Buffett studied for his first 8 years as an investor. He thought success required predicting the market's next move, obsessively charting price spikes to guess the future. This creates a miserable psychological loop. If the line goes up, you feel like a genius, but when it crashes, your stomach drops. Buffett eventually realized that 90% of the people buying stocks approach them the wrong way. They buy a piece of paper and hope their ticket goes up next week. High intelligence doesn't fix this flaw. You can have an IQ of 170, but if your psychological orientation is built around predicting daily price swings, you will likely perform worse than someone with average intellect. Buffett broke this cycle at age 19 after reading Benjamin Graham. He rejiggered his mind to follow a new rule. To succeed, you must behave as if the stock market doesn't even exist. If the stock exchange shut down permanently tomorrow, how would you invest your savings so you felt secure about getting your money back years from now? You would have to evaluate assets privately. You might buy a farm or perhaps a stable apartment house. As a private owner, you no longer care about a daily quoted price. You care about what the asset produces, the rent from the tenants or the crops from the soil. This was Buffett's big shift. He stopped buying stocks and started becoming a partial owner of publicly traded businesses. Adopting this mindset provides total emotional detachment from market panic. A true business owner actually wants the market to drop. If you are a farmer looking to expand your acreage, you hope the price of land goes down, so your money buys more soil. Shifting your focus to ownership turns market crashes into opportunities. For an owner, a falling price is a chance to acquire a larger stake in the American economy for the same amount of capital. Owning a business instead of a ticker attaches your wealth to the foundational work of the United States economy. Buffett has held absolute conviction in this strength since 1942, keeping at least 80. Yet today, the bottom 5% of earners have access to medicine, education, and transportation that the richest man on earth couldn't buy a century ago. Rockefeller couldn't pull a screen out of his pocket to watch live sports with instant replays. In just 3 lifetimes, society has leaped forward in every measurable category. Over a couple of lifetimes, a population making up roughly half of 1% of humans on Earth went to work. This tiny population block generated over 20% of the world's wealth while working normal hours with average IQs. True investing is a permanent stake in human progress, where time and the power of compounding do the heavy lifting.